All right, Rajat Bhattacharya, a senior investment strategist at Standard Chartered. He's joining us right now. Rajat, great to have you with us here. Thank you very much for your time. Will the markets pay attention to what the Fed says? Because, I mean, every week we've got so many Fed officials speaking. We've got, the Fed chair himself speaking later today. Or do you think the markets will pay attention to some of this high-frequency data, which is showing a slowdown? Yeah, go on. Let's just start there.
Morning. I think both. The market is in such a juncture that both the central banks speak as well as the data matters a lot. So watch out for Powell. I don't think he's going to surprise anyone by saying that he's going to stick to the plan that he mentioned to the Congress even last week. And that was that we are very focused on inflation. So growth is not his priority right now. He's in a good place there because, as you were discussing earlier, the US job market is very strong, right? The unemployment rate is well below the Fed's 4% long-term unemployment rate. So he's in a good place to start, accelerating the pace as they have. So I don't think he's going to deviate from that tone and expect another 75 basis points of hike next month in July. But then the data becomes important. We've seen, you mentioned, consumer confidence. That was the starter. That was the first flashpoint, if you may, of that something was going wrong with the economy. The consumers were pulling back or they're tightening their purse strings. So again, we saw last night that number fell further. The confidence number fell further. You mentioned Michigan sentiment. Now, going forward, I think some of the PCE data, for example, the PCE inflation data, which is slightly different from the CPI inflation data, that's later this week. So we need to watch that one on the underlying inflation trends. They are not going to go away. Our view is that, the inflation, the way it's shaping up, it's going to subside from here. Probably it has peaked. But even when our latest forecast suggests that the inflation in the US, the headline is going to stabilize, is going to fall towards 6%, let's say, by the end of the year. So we're not talking about 4% or 3%, it's 6% by the end of the year, then gradually fall off to 4%. But mind you, the Fed is still targeted at 2%. So it will be a long while before it settles down towards that 2% mark.
Okay. Rajat, good morning. And then what about the market action? Because the market would price it in perhaps 2 or 3 months in advance. But do you reckon that the recent lows will break in at least the equity markets?
Equities, as you saw, there was one would call a bear market rally, right? The last week's rebound. But again, it's fallen back. Equities are in that range where they're trying to look for that data that you talked about and that pivotal point of switch of the inflation expectations and the rate expectations. So I think the bond markets are signaling that we are close to that peak. I wouldn't call it a peak, but if you notice how the bond markets did, the US Treasury yields, it broke above that 3.26% that we spoke about last month when I spoke to you. It broke above that and it's fallen below that 3.26% mark. That is turning out to be a very big resistance for the yield. And interestingly, now the forward rate curves in the US have fallen below the US expectations of terminal rates. What it means is that US, let's say, is expecting the terminal rate now at 3.8%. And instead, the yields, the 10-year yields, which is a good indicator of where the terminal rates are going to be, is failing to break above 3.26%. So what it means is the market expectations for Fed rates are lower than what the Fed itself wants to be. That we haven't seen for a long, long time.
Okay. So, all right. So that perhaps builds a case that maybe a lot of it is priced into equity markets, right? If I'm not wrong, is that your base case at the moment, Rajat?
Yes, correct. So a lot of it is priced in.
All right.
We see the bond markets more priced in, which is why we like bonds more. And so we, in our latest H2 outlook, actually, we told investors that it may be time to switch from a bit from equities to bonds, because bonds have priced in this more than equities so far. Equities, if you see the past recession drawdowns, they've been at a median. Drawdowns have been 27%. The equities so far have fallen 20, 22% if you take the extreme. So equities could go a bit more, but bonds, very attractive, right? I mean, you're seeing our benchmark, the portfolio of income assets, that's yielding more than 6%.
So,
when is the last time we saw that?
Yes,
right?
yes, got that. So just trying to play the devil's advocate here, right? If you believe that this is the worst or we've hit a peak as far as inflation is concerned, and maybe the worst as far as, the impact on asset classes goes, the fear really is, as we were discussing, right? The US labor market is very strong at the moment. So people are secure about their jobs. But if the layoffs start to escalate, then all bets are off. And then we're heading into a recession for sure. Wouldn't that worry you?
That's the one to watch. So I think Fed, Powell, and the whole market is watching how far they are willing to let the unemployment rate rise. That is the key. I said the unemployment rate currently is at 3.6%. The Fed's target for long-term unemployment is 4%. I think they'll let the unemployment rate rise slowly, gradually towards that 4%, and they won't be still worried. So they will keep tightening. I think take the rates, anyway, the rates are going to return to neutral rate of around 2.4%, 2.5% by next month. And then they will tighten a bit more to slow down, raise the unemployment rate, slow down the job market, the job creation. So that shouldn't worry the market too much. What will worry us is that if inflation continues to rise, right? We're expecting inflation to peak, having peaked from 8% and fall towards 6%. What will worry us is that in coming months, if the inflation continues to rise, then you have that wage price spiral that everybody fears. Then the Fed needs to move towards that 3.8% terminal rate or even higher. That is the worry. So we don't see that yet, which is why we are relatively sanguine. We have neutral view currently in equities, and we've raised the allocation for bonds to neutral as well. So there's an opportunity in bonds, there's opportunity in income assets. They are yielding 6%. We were struggling a year ago to gain 4% yield from our income assets, income basket. Now we get 6%. So that's the way to go, and watch the data as going forward.
We had one of the largest fund managers here in India making the same point on the debt side yesterday on the show. Rajat, any specific thoughts on pockets of the market that could do well? I mean, I don't know if you track India closely, but if you do, what are your thoughts?
Yeah, so Asia is actually the pick. It's our pick in equity markets, really. I mentioned last time as well, when you mentioned where to go. So we are actually trimming our allocations to US and Euro area, which face these stagflation risks, and moving towards Asia. Why? Because the key driver there is China. China seems to have bottomed. You saw the news yesterday where they eased further the COVID restrictions, the quarantine restrictions. The markets, by the way, has moved ahead. In the last 1 month, Asia ex Japan equities have outperformed the global equities. And that is precisely because of China's turning around. I mentioned that last month when we spoke. So we are sitting on a decent outperformance there. We also like India. I mentioned last time, I will repeat that India and China both are favorites over the medium to longer term. India, I mentioned, is a bit overvalued versus the rest of Asia. China was deeply undervalued, which is why China takes the lead in this turnaround. But India has the long-term growth story. I mean, you saw people cutting back growth forecasts for this year, but to what? To 7%? And where would you get 7% growth in today's world? So, and that translates to India. The good thing about Indian stock market is that it captures the underlying growth in the economy very well. The corporates there can capture that underlying growth trend in the economy better than many other emerging markets. So India remains a good choice. China has the advantage of valuation. So that is why it has outperformed. And we see that outperformance continuing as China gradually recovers from its downturn.
Okay, Rajat, we'll leave it there today. Thanks a lot for joining us. Yes, Chinese markets have outperformed. They were, of course, at bombed out valuations, and that's been helpful. Just a quick look at the global setup right now once again, because that's really going to be overarching theme above everything else. The STX Nifty is down 150 points. The Nasdaq was down 3%, but if you were to count it from the opening bar it actually fell about 4.5% from the open high. So that, as I said, is really the most bearish chart that you can have.